All right, let's talk about the ultimate high-stakes theme park ride, the investment story of the newly merged Six Flags Entertainment. You know, the company with the ticker symbol FUN. After it joined forces with Cedar Fair, it became this absolute behemoth in the industry. But here's the thing, its stock performance has been anything but fun. So let's break down why.
Okay, so first up, you've really got to grasp the sheer scale of this new company. This merger, which happened back in July 2024, wasn't just some small deal. No, this was the creation of a brand new king in the theme park world.
And what a kingdom it is! I mean, we're talking about a combined portfolio of 42 parks. That's 27 amusement parks and 15 water parks, all across North America. Plus, they've got 9 resort properties. All in, this creates a company with an enterprise value of around $8 billion. And to steer this massive ship, they brought in a theme park veteran, John Riley, as the new CEO. That really signals they're serious about getting the execution right.
But here's where it gets interesting. Here's the puzzle. Despite being this massive industry giant, the stock is trading for around $14.50, which is right near its 52-week low. So what gives? Why is the market valuing this behemoth so cheaply?
This right here is the heart of the story. It's this complete disconnect. You see, the market looks at this new company and basically prices in a very high chance of failure. It sees all the mess and the pain of the merger. But the investment thesis we're digging into today, it sees the exact opposite. It sees a deeply discounted entry point into what could be a huge, huge comeback story. So let's meet the villain of our story. The main reason for all this pessimism. It's a mountain of debt that's casting a very long, very dark shadow over the entire operation. Nearly $5 billion. Let that sink in for a second. That's the total net debt on the books. And that's not just a number on a page. It's a staggering figure that creates immense financial pressure and really limits what the company can do.
In this chart, it just lays out the danger perfectly. Their net leverage ratio, which is basically a measure of their debt against their earnings, is sitting at about 6.2x. Now, as you can see, that is way above the 4.5x threshold where credit rating agencies like S&P start to get really nervous. And it's a long, long way from management's own goal of getting below 4.0x by 2026. They are deep in the red zone here.
And it's not just that one metric. Other financial models are flashing bright red warning signs too. Take the Altman Z-score, for example. It's a formula that's specifically designed to predict the likelihood of bankruptcy, and right now, it places the company squarely in the distress zone. This is the hard data that confirms the market's fears, and it's exactly why the stock is trading so low. But here's the thing about a turnaround story, right? There has to be a plan to actually turn things around. And management has laid out a very clear 3-part strategy to fight back, to conquer this debt, and to unlock the company's real potential.
And this is it. This is their roadmap to recovery. It's a 3-pronged attack. First up, realize synergies. That's just a fancy way of saying cut costs and make the combined company run more efficiently. Second, boost guest spending. Get more money from every single person who walks through the gates. And third, and this is a big one, invest heavily in the parks themselves to make them places people are excited to visit again. Pillar number 1 is all about finding cash. The company is targeting $180 million in annual savings from this merger. Now, this money isn't just vanishing into thin air. It's the fuel for the entire turnaround. It's coming from things like corporate restructuring and combining their tech systems, and it's going to be used to pay down that massive debt and fund new growth. They are also spending big, really big, to get people excited again. $1 billion is being pumped into the parks over the next 2 years. The bet is pretty simple. If they build incredible new high-thrill rides and seriously improve the amenities, they can attract more visitors, they can justify higher prices, and ultimately, they can drive the revenue they so desperately need. So, this all leads to a pretty dramatic climax, with 2 very, very different endings. What happens if this grand plan actually works? And, maybe more importantly, what happens if it fails? The stakes here really couldn't be any higher. And here they are, the 2 possible futures. On one side, you have the bull case. This gets triggered by a really strong 2026 summer season. If they hit their targets, get that debt down, the market could completely reevaluate the stock, maybe pushing it to $55 or even more. But on the flip side, you have the bear case. If they miss their targets, that leverage stays high, a credit downgrade is pretty much a given, and the stock could get cut in half from here, trading like a distressed asset.
So which path is it gonna be? The entire story, the fate of this company and its stock, It all hinges on how well they execute over the next 18 months. That 2026 season, that's the make-or-break moment.
Okay, so with all of that laid out, how does the source material we're analyzing actually classify this incredibly high-stakes opportunity? What's the bottom line?
The verdict is a high-risk turnaround buy. The thinking here is that the potential for really significant returns outweighs the downside risk. But that last part is absolutely key. This is an investment only for people who are prepared for some extreme volatility. It's going to be a bumpy ride. So here's the most important thing to take away from all this. This is what you'd call an asymmetric bet. Because the stock price already reflects a high chance of failure, the potential reward if they succeed is much, much larger than the remaining risk if they fail. It's a classic case study in a post-merger turnaround, and it all comes down to one key metric you can watch, that net leverage ratio. The whole game is about getting it below 4.0x by the end of 2026.
And finally, we have to end with this, and it's really important. This explainer is for informational purposes only. It is not financial advice. Fun is a highly leveraged company with some very significant risks, so please always conduct your own thorough research or talk to a qualified financial professional before making any investment decisions.